A tax freight train is bearing down on your retirement. To protect yourself, you'll have to harness the power of zero.
Hi there, David McKnight. Welcome to the Power of Zero weekly podcast. Grateful that you are with us for another episode. I am the best-selling author of The Power of Zero, Look Before You Lerp, and The Volatility Shield. If you would like to follow me on Twitter, it's at McKnight & Co., at McKnight & Co. I would love a follow, and of course would love it if you subscribed to our podcast and even gave us a rating if you felt inclined to do so. If you are looking for help in navigating your way towards the 0% tax bracket, feel free to reach out to us at davidmcknight.com. We can help hook you up with an advisor in your area who is experienced and qualified. And if you are an advisor looking to transition your practice to a Power of Zero type practice, you can head on over to powerzero.com, opt into the video series, and we would love to chat with you. Okay, today I would like to talk about the stepped up basis loophole that is a benefit for families who aren't quite rich enough to be subject to the estate tax, but who have built wealth over time through stocks and real estate investments, other properties. Maybe you're a business owner and you've accumulated some equipment. Basically, the way this stepped up basis loophole works, and after I describe how it works, I'm going to tell you how much longer I think it's going to last. The way it works is, let me give you an example. Let's say that you have an investment that's worth $200,000. It's sitting in your taxable bucket. So in other words, it's not in an IRA. It's not in a Roth IRA. It's just sitting in a taxable brokerage account, what have you. Let's say you paid $100,000 for it. It's now worth $200,000. Over time, it grows and compounds. You don't spend it. And by the time you die, it's worth $1 million. So your cost basis was $100,000. In other words, what you paid for is $100,000. It's worth $1 million, and it goes to your beneficiaries. Let's say it goes to your son or your daughter. They inherit it, and the way this stepped up basis loophole works is essentially that basis that you had of $100,000 goes away, and whatever the value was at the date of your death that they inherit it, becomes the new basis. Okay? So, effectively, that $900,000 capital gain got completely wiped out. So this is a really good deal. In fact, a lot of people compare it favorably to inheriting a Roth IRA or inheriting a Roth 401k. I'll talk about why I don't think that's the case, but a lot of people will compare it favorably to those types of things. This is great for anybody who might otherwise be subject to an estate tax if they had an estate that was worth more than 23.16 million. Currently, the way it works is if you have an estate that's worth more than 23.16 million, anything above and beyond that 23.16 million, if you're married, gets subject to a 40% estate tax. Okay, so you may be paying, if it's in an IRA, you might be paying tax on that IRA along with that estate tax. So pretty punitive, but if you have an estate that's worth less than 23.16 million and you have it all in your taxable bucket, guess what? That can go tax-free to the next generation based on current tax law. So let's be clear, this is a loophole. And what happens to loopholes as time wears on? Well, as we're about to discuss, loopholes become the target of a revenue-starved federal government. So let's talk a little bit about, first, what is the fallacy behind why it's a good idea to grow money in the taxable bucket versus the tax-free. A lot of people say that this compares favorably to a Roth IRA, and I'm going to give you 4 reasons why it does not compare favorably to a Roth IRA. First of all, let's say you're investing in Apple stock. That Apple stock is peeling off dividends, okay? You're getting dividends, and as you receive those dividends, even if you reinvest them back into your Apple stock purchase, you still are going to have to pay tax on them. So it's not growing. And remember, dividends can account for, 20 to 30% of the growth of a stock in any given year. So that can really stymie the growth of your portfolio over time if you have to pay tax on those dividends. Number two, because you have to pay tax on those dividends, you are exposed to tax rate risk along the way. So in other words, should tax rates rise dramatically over time, then the portion of the tax or the amount of tax that you have to pay on those dividends likewise can go up. We also have to remember that any 1099s, because of those dividends that come out of your taxable bucket, count as provisional income. So that can potentially cause your Social Security to be taxed along the way. Not only do you lose the Social Security, but you lose what that Social Security could have earned for you had you not had to liquidate your other investments to compensate for the hole in your Social Security. And then finally, as I'm about to explain, this loophole is going to be coming under fire as we slowly slide into insolvency, as the national debt starts to skyrocket, as we have fewer and fewer resources with which to pay our bills as a federal government year over year over year. They're going to be looking in all quarters for ways to fill the hole in their budget. They're not going to be able to borrow money forever. It's just not sustainable, and everybody's talking about it. I was sounding like Donald Trump there. It's not sustainable, and everybody knows it. Anyway, so let's talk about what Joe Biden is proposing. As you know, I'm a very apolitical person in these podcasts, so I'm going to keep it very apolitical here. But let's just talk about what Joe Biden is proposing. He's proposing that step up in basis be totally done away with. Now, let's be clear. In order for that to happen, he's got to be able to have the votes, right? He's got to have the votes in the Congress. He's got to have the votes, or in the House. He's got to have the votes in the Senate. And he's actually got to win, right? So he's proposing that the step-up basis loophole be done away with. So what does that mean? That means that if you inherit money, you also inherit the basis that the person who passed this money on to you or these investments on to you had. So in that example that we had earlier, let's say that your mom passes money on to you, and the basis of that investment was $100,000, but it's worth $1 million by the time you inherit it. Well, guess what? You're going to inherit that same basis, which is $100,000. Okay. Now, currently, under Joe Biden's current proposal, you would have to pay basically long-term capital gains, which, basically 20% on that, the difference between the 100,000 and the million. Now, this is where it gets really, really nasty. If you have income that's greater than $1 million, you would be required to pay tax on the difference between the 100,000 and the million at your highest marginal tax bracket. And keep in mind, Joe Biden wants to make that highest marginal tax bracket of 37 go away. He wants to essentially go back immediately to the tax rates that we had in 2017 before the Tax Cut and Jobs Act. So he wants to go back to, highest marginal tax bracket of 39.6. So let's be clear. If you were to inherit this money, you would be taxed on the difference between the million and the 100,000, so that 900,000 at 39.6% taxes. Guess what? That's awfully close to the 40% estate tax that you are currently not subject to until you hit $23.16 million as a married couple. So, big taxes coming down the road. You may think that you are in a position where, hey, I'm just gonna let my stock grow and accumulate within that taxable bucket. I don't really care if I've got to pay a little bit of tax along the way because I'm only really paying it on the dividends. I'm not paying it on the growth of the stock itself. Well, guess what? All of that can change. The lawmakers have their sights squarely trained on this particular loophole. And in an effort to keep our country solvent, this is one of the first things to go. I see people come up to me all the time and say, Dave, why don't I just accumulate all my money in my taxable bucket? Yeah, it's less efficient along the way, but I can pass all that money on to the next generation versus, growing money in a Roth, in a traditional IRA where my heirs would have to pay potentially as high as 50% as they draw that money down over the course of 10 years. The thing that really boggles my mind is people are saying that the current tax law is even preferable to the Roth IRA, because with the Roth IRA, you have to liquidate that money within 10 years. With the step-up basis loophole, if you inherit $1 million from your parents, you do not have to liquidate that money. You got the new basis, and then you simply pay taxes on whatever you pay, long-term capital gains on whatever, so long as you keep it longer than a year, on whatever growth you experience from that time forward. So they're saying that that's even better than a Roth IRA or an inherited Roth IRA, because you don't have the same handcuffs that you might with the inherited Roth IRA. So I want everybody to be aware that even though this loophole has been around for a while, and even though it's very attractive, if you are building your financial plan around the likelihood that this loophole is going to be around 5, 10, 15, even 20 years from now, it's just not going to be the case. I'm looking into my crystal ball and I'm seeing this is the thing that lawmakers are going to go for. It's just a question of time before you get the right combination of lawmakers in office that control the House, the Senate, and the presidency. It's just a question of time before the stars align, and this is the first thing they're going to go for. And Joe Biden has put everyone on notice that if he can get the votes, this is the thing that he's going to be eliminating. So as we move forward in time, we have to start looking at things like, the 4 to 6 different streams of tax-free income that I'm constantly talking about. I'm talking about life insurance. Here's the thing about life insurance is, by law, that goes tax-free to the next generation. That's not even a tax loophole. That's actually, it's an inveterate part of the IRS tax code. It's been around forever. This tax loophole for the step-up in basis has not been around forever, but life insurance has. I think they're much likelier to go for the tax loophole for stepped up in basis and investments in your taxable bucket than they are life insurance. So life insurance has been around forever. You can pass that money tax-free on to the next generation. It's not susceptible to the 10-year rule where you got to spend that money down, and you're not going to be in danger of having that step-up basis loophole eliminated like you would in the taxable bucket. So I guess bottom line is, make sure you're maxing out your Roth 401ks, or at least putting up into the match. Make sure that you're maxing out your Roth IRAs every year. If you're below that $196,000 modified adjusted gross income limit, make sure that you're taking advantage of Roth conversions while tax rates are low, and make sure that you're funding your LIRPs. These are all things that are going to be immune, or inoculated, if you will, from the impact of this tax change that's coming down the pike, should Joe Biden win the presidency and should he gain control of the Senate. We know he's got control of the House, but if he gains control of the Senate, then we've got, this is likely a tax change that we're going to have to reckon with. Whatever way you slice it, we are going to be looking at higher tax rates in the future. Republican, Democrat, we are looking at higher tax rates in the future. I think it's going to go much higher, much quicker under Democrats. Republicans are going to have no choice, but they're going to drag this thing out. They're going to try to, dissemble and hem and haw, because it goes so counter to everything that they've talked about and preached about. It goes counter to their platform, but it's going to have to happen sooner or later. So both sides are going to have to raise taxes. One's going to do it faster than the other, but both sides are going to be doing it. Just a question of time before this step up in basis loophole gets completely eliminated. So we have to start planning with the expectation that it's not going to be around when we die. So utilize investments, utilize tax accounts that are going to be most beneficial to you in passing money on to the next generation. That is the show for today. Appreciate you being on for another week. We look forward to chatting with you next week. Again, please subscribe. You will get an email every week telling you exactly what we'll be talking about, and you'll be able to access it right there in your email inbox. One last reminder, I'm going to be putting out the cover to my new book, Tax-Free Income for Life. The cover is amazing. We worked really hard on it, and Penguin Random House has some very, very talented people over there working on the cover. And so I'm going to be putting that out very soon. Again, the launch date for that is November 17th, and we're going to be putting out more podcasts talking about the types of things we'll be talking about in that book as we get closer and closer to launch time. Thanks, everybody, for being with us. We'll look forward to chatting with you next week.